we're joined now by Joshua Raymond, market analyst for City Index Group in London. Thanks very much for joining us this morning, Joshua. Firstly, could I ask you, I've seen this morning UBS has published a research note about possible consequences if the euro broke up. Is that really something that analysts are taking seriously as a possibility, or is this just sort of the standard hype and hysteria that we do sometimes see on the markets?
I think you have to take it seriously. I think if you're looking at the broad political fragmentation that we've seen across the Eurozone as a whole, between obviously the stronger nations such as Germany and France to the weaker indebted nations such as the PIGS nations, so Portugal, Italy, Spain and the like. So certainly the political fragmentation does indicate that is absolutely a potential that we could see a breakup of the euro sooner rather than later. I think probably, in my own opinion, I think we're probably one way or another. I think the euro that we saw 2 years ago is absolutely not going to be the same picture in a year's time. I think it needs to go one of two ways. One way, obviously, which is greater fiscal solidarity and greater fiscal union, which unfortunately I think it can only be created through a loss of sovereignty, a loss of fiscal sovereignty to a centralised hub in Brussels, which has already been indicated by Merkel and Sarkozy as potentially one of the measures of which a Eurobond could actually come through. So I think it's either going to go that way, or we could see a breakup of the euro, and everyone goes back to their sort of autonomous nature, so to speak. So I don't think that the market should be ignoring the potential for a breakup.
Joshua, what action do Eurozone leaders need to take now at this stage to regain confidence, in your view?
I think we need to see some strong government action. I think we also need to probably see some liquidity into the markets as well. I think if you're looking at the stock markets, basically, we always pay attention to one of two ways. One is greed and one is fear. And right now, the markets are particularly in fear mode. They have been for the last 6 or 7 weeks, really. Now, if you're looking at bond yields at the moment, you're looking at Italian 10-year bond yields going towards the 6% mark again. If you're looking at US Treasuries, which are the safe haven plays, below 2% on the 10-year yields. So effectively what you're looking at is a market afraid to take on any risk at the moment. And what we want to see is particularly stronger actions from the EFSF, the European Financial Stability Facility, needs to be propped up. I think that's certainly one of the calls from the markets at the moment. And again, whilst you've got other governments such as Germany considering whether that's actually legal, the first bout of bailout funds for Greece, for instance, then I think it's keeping a lot of uncertainty in the markets.
Exactly, a lot of worries over the European Financial Stability Fund, aren't there? But of course, there are also problems in the US. Is it possible to say how much those are weighing on the markets as well as the EU worries?
Well, I think there are probably two worries that are mainly gripping the markets at the moment. One is obviously the sovereign debt crisis, and the other factor, which is actually linked, of course, is global growth, potential slowing of global growth, which we've seen a lot of economic data point towards over the last couple of months, of which you would include the UK, for instance, broader European, as well as the US and emerging economies like China and India. So I think that is a global concern about slowing growth, of which the US would be included in that. I don't think, I think depending on which way you want to argue, potential to slip into a double-dip recession in the US. I think that's still unlikely at the moment. But again, you've got to look at economic data, which is backward-looking, while stock markets are forward-looking. So everyone's trying to second-guess which way the curve is going.
OK, Joshua Raymond from City Index Group in London. Thanks very much for joining us this morning. And of course, we'll be keeping a close eye on that all day and in the future as it develops.